Wolfspeed's first full session after earnings is complete, and the market kept almost the exact discount seen after hours. Wolf closed down 9.3%. The question is whether fast AI growth can overcome the company's weak near-term economics. This is educational research, not financial advice. Please verify all data independently. The headline bar was modest, roughly $150 million of revenue and a smaller adjusted loss. The harder test was operational. Investors wanted proof that AI demand could fill factories, improve margins, and reduce cash burn. The scoreboard was mixed, rather than disastrous. Revenue was essentially in line, while the adjusted loss was better than expected. Those results alone do not explain the sell-off, so the market looked deeper into revenue quality and profitability. The initial after-hours drop held through the next close, despite a very wide intraday range and twice normal volume. Since the semiconductor benchmark rose, this looked mainly like a Wolfspeed-specific repricing rather than a broad chip sell-off. AI data center revenue more than doubled for the fiscal year and grew again in Q4. That is the strongest part of the report. However, both disclosed product groups declined, which means AI is not yet large enough to drive total company growth. Cash use improved dramatically as capital spending fell. But the core manufacturing problem remains. A negative gross margin means product costs still exceed revenue before operating expenses. Underused factories are turning Wolfspeed's scale into a burden for now. Next quarter guidance did not show a clear rebound. The revenue midpoint is almost unchanged from Q4, and adjusted gross margin should stay negative. Investors still lack a timetable for the financial inflection they want. Management is building a more focused AI data center effort and launching newer silicon carbide products. Yet the annual filing also warns that AI demand can change quickly, and that underutilization costs may persist until demand catches capacity. AI momentum, sequential margin progress, and lower cash use all improved. But total revenue contracted, gross margins stayed deeply negative, and guidance remained nearly flat. The disappointments still dominate the near-term valuation argument. Before earnings, the bull case said restructuring and large-scale manufacturing could create operating leverage. After earnings, AI participation looks more credible, but the financial conversion remains unproven. The thesis now depends on how quickly demand can raise utilization. Bulls can point to rapid AI growth, valuable manufacturing assets, and a much better cash flow trend. Bears can point to shrinking revenue, negative factory economics, and ongoing balance sheet risk. Both sides now have clearer evidence. The small pre-release analyst cohort leaned neutral, with an average target near the post-earnings close. These targets can change after new results. They are neither Wolfspeed guidance nor reliable predictions of where the stock will trade. Do not get lost in every line item. Watch 4 measurable signals: revenue within guidance, progress towards zero gross margin, a dollar value for AI revenue, and whether utilization and cash flow continue improving. AI momentum scored well, but profitability and guidance did not. The full-day verdict is that Wolfspeed remains a high-risk AI infrastructure turnaround. To earn a stronger valuation, it must turn AI demand into company-wide growth, positive gross margin, and durable cash generation. Thanks for watching. Like, share, and subscribe. Then visit AIStockshub.com.